Hi, and welcome back. In today's session, we're going to take a look at forecasting cash flows. In class last week, we had an introduction to the Tesla case study, and we got a bit of a flavor for the way that we forecast. In this session, we're going to go into a little bit more of the detail and take a look at how we arrived at some of those numbers, and quite a bit more detail. So today, we're going to have a quick introduction to the process of financial planning. As well, we'll look at two different approaches to doing forecasting. The additional funds needed approach, or the AFN approach, and the method we looked at with Tesla, the pro forma financial statements. Starting off with sales forecasts and applying the percentage of sales to understand how we got the different numbers in the income statement and balance sheet information. First off, when we start to talk about a process of planning for the future, almost a redundant term because we only have to plan for a future. And the more interesting the changes in the future will be, the more challenging that planning is going to be. Also, the longer the duration of our forecasts, the more variables can affect that change. So we know that one of the most interesting problems that we have is how to forecast sales and sales growth into the future. In order to understand that, we're going to have to take a look at some of the expenses, and in particular, the increases in fixed assets, inventories, receivables. From this information, we can predict how much funding is going to be available from our own operations, how much the funding will grow with the scale of the operation. And once we have that information, we can look for other sources of funding beyond the internally generated funds. Once we know that, we can start to decide how to raise funds. And then finally, we can see the effect of this plan on the ratios and ultimately the value of our shares. Now, when we think about forecasting, we talk about the weather, for example. We know it's relatively easy to forecast for the short term, and ultimately we need to try to forecast for the longer term. And right now, trying to predict the weather 2 weeks in advance is highly speculative. Our forecasts for tomorrow morning, are probably going to be pretty close to correct because we have several sources of information. We have the historical patterns, so we can take a look at weather temperatures during this month going back for over 100 years. That gives us a baseline. We can also look for other sources of information. And when we're talking about weather, we have weather ships and satellites and ocean temperature measuring devices and all kinds of inputs. That information tends to give us very good data about the next 3 or 4 days. But beyond that, we start to go back to the regression. In fact, if you think about any kind of a forecast, typically our forecast starts off by looking at the trend of behavior over the last few weeks, the last few months, or the last few years. From this, we can start to predict into the future, adding in all of those variables. And you may have seen a diagram like this before, but it says that from the dotted line going forward, we've got a central tendency, and that's our expected prediction. But the color bands demonstrate the variability, high and low, and you'll see that the bands get wider as we go into the future. That's our room for error. So we think we know what a number is going to be, but we also know that those numbers can be quite a bit off as we go on into the future. An accurate sales forecast, then, is going to be the first thing that helps us to understand the future ability to fund the business, future profitability. It starts off with a review of historical patterns. What have our sales looked like in the past? What has our growth been in a normal year and a good year and a bad year in the past? And we can use a regression analysis to forecast from our own sales behavior. So if somebody says, can you tell me about the next 5 years of a company, without knowing the company very well, you can start by using the past patterns. Then we start to adjust that estimate with other details. For example, do we expect certain key costs to rise faster than others? If oil or steel, coal, timber is one of the main inputs for your product, do you expect those costs to rise in the future, to fall? Some of the expenses, the cost of labor, the cost of real estate, things like that may also affect your estimates for the future. Now, entrepreneurs tend to be very good at doing forecasting. They don't require a computer. Or they can generally get an idea just from the information in a discussion. Now, often they can work with 4 or 5 bits of information, and from that, on the back of a napkin, they can probably chart out the expected profitability of a new deal, and they do that all the time. They probably don't realize that they're doing it a lot of the time. It's part of that entrepreneurial ability, that capability that some people have and some people don't. And we describe that method in finance as the additional funds needed approach. We start off with a few assumptions to say, before we do anything, we assume that the business is operating at full capacity already. It's using all of its assets all of the time, so any new business is going to require additional equipment. We also perhaps make a simplifying assumption that all of the different types of assets that we control grow proportionally with sales. We say that some of our expenses, and we'll describe these later as spontaneous liabilities, things like accounts payable and accruals, are going to grow proportionally with sales. That the profit margin and the payout profit margin will be sustained, and dividend payouts perhaps will be maintained. And that leaves us with one bit of information that we do have to question, and that's going to be the level of sales. From this, we can see that there are going to be 5 variables that are going to help us to understand the ability of the company to sustain that level of growth, to be able to forecast the funding requirement, the AFN. The first is the capital intensity. Remember we talked about fixed assets to sales. High capital intensity makes it very difficult for a company to grow. And the measure that we use is the asset to sales ratio. And my notation here is A star. Basically, that's going to be the stylized or assets, or actual assets. And S sub 0 is our sales in the base year. So last year, we can take a look at last year's total assets and divide that by last year's sales. And that's our capital intensity ratio. Delta S, that triangle delta, is the change in sales from one year to the next in dollar terms or in percentage terms. The liabilities to sales, remember we talked about spontaneous liabilities. Those are the accounts payables and the accruals. And here are liabilities to sales in year 0 is that liabilities to sales ratio. M is our profit margin, basically the net income to sales from our last year's or forecast profit margin. And RR is the retention ratio. That's the percentage of our income, our net income, that's not paid out as a dividend. We can take that as 1 minus the actual dividend that's paid out. Well, let's take a quick look back at the assets to sales to get an idea of how that works. Now, you can see in this diagram that we've charted assets on one axis and sales on the other. Essentially, this says that there's a relationship between assets and sales where we have a 67% asset to sales ratio. That's the way that it's worked historically. We assume that's the way it's going to work in the past. And at the moment, we have managed to do about $3 million in sales with $2 million in assets, which essentially says we require 67% of our sales in assets. Simple so far. If we're going to increase our sales by 10%, we would assume that that would take us to $3.3 million, and that would require an increase in assets of $200,000. The difference, the $200,000 increase in assets, matches the $300,000 increase in our in our sales, and that maintains that 2 divided by 3, or 0.67% ratio. So therefore, our change in assets, the asset to sales ratio times the change in sales, or 0.67 times the $300,000 increase in sales, or $200 increase in fixed assets. If we want to check that to make sure that that's right, we can see that our original value, 2 million in assets divided by 3 million sales, gives us 0.67. 2.2 million, the forecast assets, divided by 3.3 million, the forecast sales, also is 0.67. So that looks like it works. If our sales are going to increase by $300 million then, what is the AFN? This is the beauty of this particular approach. It's very simple. With a few simplifying assumptions, on the back of a napkin, we can very quickly work this out. Entrepreneurs, as I mentioned, may actually do this in their head and they don't even know they're doing it. The formula essentially says that the additional fund requirement depends on the capital intensity times the change in sales minus the liabilities divided by sales times the change in sales minus the profit margin in the forecast year S sub 1 times the retention ratio. Remember that these subscripts, S0 means last year and S1 means this year. So I'm thinking about two things. How much am I going to have to spend on new assets? Can I fund part of those new assets with funding from suppliers? That's the second term. And how much of that can I pay off with the increased profitability that I'm going to get from those incremental sales after paying out my dividend at the usual rate? In words then, the AFN projected increase in assets minus the spontaneous liabilities, or the amount that's going to be funded by suppliers, minus the increase in our retained profits. So if we use the numbers from the previous example, $2 million in assets divided by $3 million in sales, that's our historical capital intensity ratio, times the change in sales from $3 million to $3.3 million. The $300,000 is the change in sales. That's going to be the amount that we're going to have to spend to expand our assets to do the new business. We can pay for part of that, and here we've got $200,000 is our increase in our actual payables divided by $3 million in total sales times the change in sales. That gives us about 6.7% of our additional asset base that's going to be paid for by our suppliers. The third thing that we need to know, how much of this will be paid from profits? Now, our profit margin is 3.78%, close to 4%. And we're predicting next year we're going to do $3.3 million in sales. So about 4% times $3.3 million gives us the profit that we're going to make from those total sales. And then our dividend rate was about 50%, 50.7%. So 1 minus 50.7 gives us the retention ratio. About 49%, almost 50% of what we earn from our sales this year is going to be retained by the company, and the other half goes to our investors. So the product of all of this calculation says that our additional funding requirement is a little over $118 million. That's how much money we're going to have to find to fund the business. From the bank, from our shareholders, from whatever source is going to be relevant. But that's how much it's going to cost us to add another $300,000 of sales to our business. Now, how would increases or decreases in these numbers affect our business? Well, if our sales are higher than predicted, we're going to require more assets, which is going to also increase the funding requirement. In some ways, one of the most dangerous times that a company faces is when it grows, because it needs additional funding. If they pay out a higher dividend payout ratio, that's going to decrease the funding available, also increasing the additional funding requirement. If they have a higher capital intensity ratio, maybe they're using better machinery, they're creating more capital intensive production, that's also going to increase the funding requirement and the AFN. Higher profit margin, on the other hand, would increase the funds available internally, and it would decrease the AFN. And if we pay our suppliers sooner, well, that means that fewer of our assets are going to be paid for by suppliers. We're also going to have to increase the AFN. So this gives us a feeling for the way that the AFN works. Some of the implications, if that's a positive number, that's the money that you're going to have to fund, the amount of money you're going to have to fund in order to do the increased business. On the other hand, if it's a negative number, that means the additional sales is going to produce a cash surplus, and you can use that to pay off debt, buy back your own stock, invest in other companies, Pay a big bonus to managers, whatever you'd like to do. But that essentially is going to be the information that we get. Now, remember I said this is a simple method. That's the beauty of it. It's simplicity. We start off with a few assumptions. We work with 5 different variables. We can calculate this without even a calculator. You can do this one with your fingers. Simple. That's the attraction of it. Unfortunately, simplicity is usually the enemy of versatility, and an alternative method is much more versatile. That's the percentage of sales method. So for the percentage of sales, or the forecast financial statement method, we're going to forecast a complete set of financial statements. We call these pro forma financial statements, and these are forecast based on assumptions. And that's essentially what we mean by pro forma. It gives us a more interesting and a more reliable analysis, but it's still going to be a lot more work, and you probably need more than a napkin to work this one out with. The information provides us with the opportunity to calculate financial ratios to understand whether or not different business alternatives and different assumptions make more sense. For this, we use our percentage of sales method that we talked about earlier. We start off with our sales forecast, and from this we estimate the balance sheet. What are the assets and the liabilities going to look like after we've done this forecast? And we can allow these assets and liabilities to grow at different rates according to more realistic assumptions. It may be that we don't have to increase certain fixed assets, or perhaps our inventories will not have to increase in order to do the sales. Those assumptions can be made at different rates. A lot more complicated than the previous method, but it gives us a lot more information. The first steps that we're going to take are to predict items that are going to increase as a percentage of sales. And that includes our costs, including all of our variable costs, things like research and development and selling general and admin costs, or cost of goods sold. Any cash balances that we have to maintain, accounts receivable, inventory, our change in fixed assets, and also the accounts payable and accruals on the other side of the balance sheet. There's some items that are not going to increase in a linear fashion with the increase in sales, and these are things that we'll make separate decisions about later. I mentioned this earlier. Things like debt. Are we going to take on more long-term debt? Are we going to increase our dividend payout, or perhaps restrict it in order to fund that growth? How about issuance of common stock, or maybe buying back common stock? Those are all discretionary. They don't change with the level of sales. So these are some of the things that we're going to start to work with. Now, we'll see that we start off by looking at the historical information. As I mentioned earlier, we can take last year, we can take an average of several years in the past, and use that to create a baseline. Now, in this particular example we're looking at, we're going to forecast the 2021 financial statements. And to do this, we started off with some information from the historical accounts. Last year we had a total cost, all of our costs, excluding depreciation, were 87.2%. We're just going to use the same number. In fact, all of these numbers, we're going to just use last year's numbers in our base case scenario. Cash to sales, 0.33%. Account receivables to sales, 12.5%. Inventory to sales, over 20%. Fixed assets to sales, about 33%. You get the idea. We can change these later. Perhaps we're going to decide these numbers don't really make sense anymore in our new larger company, in the new activities that we're taking on. But this will be our basic case. We have a few other assumptions or inputs that we're going to add. The first thing is that we're going to grow our business by 10%. The interest rate on our debt is going to be 11% on long-term debt and 9% on short-term debt. We'll come back to that one in just a second. Tax rate is 40%, and dividend payout rate still 50.7%. Now, our first step is to look at the income statement. And you remember when I looked at Tesla, I did all the work on the income statement. I didn't even use the balance sheet. Today we'll look at the income statement and the balance sheet before we do the total forecast. Percentage of sales. Last year we started off started off with $3 million in sales. Our assumption was we're going to increase our sales by 10%. So our sales for this year, for our forecast year, are going to be 1 plus the 10% growth rate times the $3 million in sales last year. And that's where we got the $3.3 million. Now, percentage of sales, our costs were 87% of sales, and 80% of this year's sales, up here at the top, is $2.878 million. Depreciation expense, well, we get that by taking a look at the fixed assets in the balance sheet. And I'll show you those in a moment. But we were forecasting to have in 2021 $1.1 million in fixed assets, in net fixed assets, and 10% of that would be $110,000. From that, we calculate our operating profit of $312 million. Now, interest is calculated on the basis of last year's short-term and long-term debt, and the numbers that I had from this particular case were 9% for short-term debt and 11% for long-term debt. And we don't really need much more information about that, but the total amount is $92.8 million in interest, which gives us earnings before tax of about $220 million. Tax at 40%. 40% of $220 million is about $88 million. And subtract that from our earnings before tax, and that gives us our net income before our preferred dividend. Preferred dividends, you know all about preferred shares. That was $4 million, and it has to be paid out before we can consider distribution of any money. And so that leaves us with net income available to the common shareholders of about $128 million. Now, we pay a dividend of that increases with year from year to year at 8%. So that's why we have to pay 108% of last year's dividend. Just part of the case information. And we have 50 million shares times 108% of last year's dividend per share. And that gives us $62.5 million that has to be paid out to our common shareholders, which leaves us with a total that we can add to our retained earnings of $65.3 million. That's an important number because that can also be used to fund the additional assets that are required to grow the business. So that's going to be a number we're going to carry forward. Now, our balance sheet is going to require two sets of calculations, the assets and the liabilities. So to start with, we said that our cash was going to be 1/3% of our forecast sales. So 0.33 times $3,300,000 is $11,000. 12.5% of our forecast sales gives us account receivables of $412.5. 20.5% of our forecast sales is $677 million. Now, our total current assets then, the sum of all of these is $1.1 million. Our fixed assets are going to be 33.3% from the past asset to sales ratio of our forecast sales. And 1/3 of $3.3 million is $1.1 million. So we add the total current assets and the total fixed assets, and that gives us a total balance sheet value for assets of $2.2 million. Remember that our assets are $2.2 million, so logically our liabilities and equity also have to be $2.2 million. And surprise, this balance sheet balances. But it wasn't easy to make that happen, and I'll show you why. Accounts payables, accruals, those were numbers that were given from our assumptions, from our past patterns, and we multiplied those by sales to get the values for accruals. Notes payable, something called the plug technique. So we're going to skip that one for now, and I'll show you exactly how that one works. Long-term debt is just carried over from the past because remember that's a discretionary number. We decide whether to increase it or decrease it. And for now, we decide to leave the long-term debt, preferred stock, and our common stock as they were in the previous year. So we just carry that information over. Retained earnings last year were $766 million, and from the income statement we add $65.3 million. That gives us 831.3, our retained earnings at the end of our forecast year. Now, this is the interesting bit. If we took all of these numbers together and we just used last year's notes payable, we'd be out by about $114 million. And so to fix that, well, we're going to make some adjustments. So that's where we get the difference of $114.7 million. We plug in the difference to make the balance sheet balance. This is without the adjustments to the notes payable. These are the numbers we'd have. Our balance sheet liabilities and equity would only come to $2,085,000. That's with the $110 million in notes payable. If we take that difference and add that in, now that comes to 224.7, and our balance sheet balances. So that's what we mean by a plug number, the number that you plug in to make everything else work. And it kind of makes sense, because without that additional funding of $114.7 million, you couldn't pay for all of the required assets, increase in working capital that you need in order to do the increased sales. I still don't know where we're going to get that money from. I don't know that my bank's going to lend me an extra $115 million. Maybe I will have to find different ways to fund it in long-term debt or common shares. But however this works, that's the additional funding requirement. So, just kind of a reminder, required assets $2.2 million. The sources of finance that we specified before the AFN, $2,085,000. The forecast funding requirement then is that difference, 114.7. We have to have the increase in inventories and accounts receivable funding in order to make the sales. We have to have the fixed assets, so that means we have a funding requirement of 114.7. If we make an assumption that we're not going to issue new long-term debt, preferred shares, or common shares, then all external funds must be raised as notes payable. And that means we're going to have additional notes payable of 114.7. And we use that plug technique to be able to get that information. Now, comparing our two different approaches. In the first approach, the AFN, the back of the napkin approach, we had a total funding requirement of 118 and change. For the pro forma AFN, using the forecast sales, we ended up with 114.7. About $4 million difference in between the two approaches. The AFN equation assumed a different profit margin. The pro forma method made specific assumptions about everything that was going to happen during that year. All of the changes to inventories, receivables, payables, cash, and so on. So it provides a lot more information to use when we're trying to understand how that's going to work. So we like the pro forma method best. It provides the greatest richness, and I'll show you how we can use that in the next few slides. We'll take a look at how we can use that to understand the success of the business. To do that, we're going to look at a number of ratios, and all of these you've seen before. Things like the current ratio, our actual and our forecast in the first two columns, but then the industry average on the right-hand side. And from this, we start to make some assumptions about how well this company is doing and whether it should be doing better. Current ratio is about 3.2, and it's going to fall in the new model. But it's already below the industry average, and it's going to get lower. Inventory turnover is significantly lower than the industry, and this one bothers me a lot more. Days sales outstanding, quite high compared to the industry, and they're not going to get any better. Our asset turnover is below the industry average. That's also a problem. Our debt is going to actually improve with this model, at least our long-term debt is. Our profit margin is below the industry average. It's going to get a bit better, but not much. Return on assets, a bit better, but still below the industry average. ROE improving, but still below the industry average. And return on invested capital is well below the industry average. So, I don't know. We should be able to fix this. I'll take a look at that in a minute. Let's take a look first at our free cash flows to understand whether or not this is going to be a cash generative proposition or not. In 2020, we had our current assets minus those current liabilities, the net operating working capital, $800 million. That increases in 2021 by $80 million because we have to fund the additional sales. Our operating capital also increases by 10% with that 10% increase in sales from 1.8 million to from 1.8 million dollars to 1.98, and so that's a substantial increase, $180 million. That's billions and billions, The net operating profit after tax, our operating profit times 1 minus the corporate tax rate of 40%, was $170 million in 2020, and we forecast it's going to rise to 187. That $187 million increase has to fund the investment in our operating capital, $100 million in new fixed assets and $80 million in additional working capital. So the NOPAT minus the investment in the operating capital means that we're going to generate $7.4 million in available cash flow, in free cash flow. Last year that was a negative number. So this is a significant improvement. And we get the return on invested capital number we're going to be looking at a little bit more later. That's the net operating profit after tax divided by the total operating capital, and that comes out to 9.5%. That may be a good number, but it's clearly not as good as the rest of the industry. That's a number we'd really like to improve. That determines our ability to create shareholder value. How can we do better? Well, some of the standard things that managers would look at. Can we improve our working capital management? Tighten up our credit policy. We're about 10 days longer than the rest of the industry. So if we can do that, before we were at 12.5% days sales outstanding divided by, accounts receivable divided by sales. Let's try and cut that to 11.8. Inventory to sales was 20.5%. Can we cut that to 16.7? Maybe we can, I don't know if we have to lay off workers, but whatever we do, can we get about 1.2% better costs? Reduce our costs by 1.2%. Now, if we plug those numbers back into the model, run it again, this is the impact of the improvement of making those three changes. Well, our day sales outstanding drop, our inventory turnover increases, not nearly to the industry average, but it's doing better. Our net operating profit after tax increases to about $211 million. The operating working capital actually falls from $800 million to $731 million. So we don't have to fund additional working capital. We're going to be releasing capital from our inventory and our accounts receivable. The net operating capital was $1.8 million. Now it's going to only be $1.831 because we still have to increase our investment in our fixed assets, but not in working capital. And that means our free cash flows improved from $7.4 million to $179 million. Since we only needed $114 million to fund our growth, and we generated $179 million, $180 million, that means our AFN went from being a positive number that you had to fund, to a negative number, the number that's going to be, the money that's going to be available to use to pay down your debts, increase the dividends, or buy a new jet for the management to fly around in. Nice jet for $57 million. In any case, our return on invested capital has increased to 11.5%, pretty close to the industry average, and our ROE is even better at 15.4%. So those are all great improvements. You kind of get the gist of how this works. by doing the whole set of forecast, income statement, balance sheet, we can now see the effects of changing different assumptions. We don't just have one pro forma statement, we have many pro forma. Different assumptions, different pro forma. There are 3 different cases where we can also do better by working with a slightly different view of the way that our assets to sales work. Now, the basic assumptions you can see from the small chart in the corner. That's what we saw on our slide at the very beginning of this session. And it made one simple assumption, that we had our asset to sales requirements increasing from a base of 0. In the original model, the slope of the line was 0.67, but the origin was 0. In other words, we made an assumption that if we did 0 sales, we could have 0 assets. And in the real world, we know that that's not going to happen very often. Typically, we have to have a certain base of machinery, maybe a building and a few machines. So if we end up doing 0 sales, we're still going to have a certain minimum amount of assets. Maybe we have to have a base of $200 or $250 million in assets just to have a factory. And then we add machines as we go along. So if that's going to be our base, and slightly different example with slightly different numbers on this axis. If we are doing $200 million in sales, say we need $300 million in assets. That means we have about a 1.5 asset to sales ratio. If we increase our sales, if we double our sales with the same line, essentially we'd have to have $400 million in assets to do $400 million in sales. So the slope at the first point, 300 million divided by 200 million was 1.5. 400 divided by 400, so the slope becomes 1. The declining ratio essentially describes what we mean by increasing economies of scale. As the scale of the company becomes larger, the cost of adding new sales tends to fall. And this starts off with our basic assumption that you can't do business working from no assets. The second special case when we're talking about assets are when our asset demand increases in large increments, or speaking scientifically, they're lumpy. Imagine you're running an airline. You're doing very well. You've got an airplane, you've got a pilot, you have a flight attendant, you run back and forth between 2 cities. Your sales increase because everybody's heard what a great airline you're running. And you get to a point where you're reaching 100% capacity. You have a meeting of the management, and in this case the management of the pilot, the flight attendant, and their daughter who bakes the cookies for the flight. And they all get together and they decide, well, we really want to increase the size of our airline. Let's go out and buy 10% of a new airplane. Yeah, it's not practical. So they're going to have to double their assets. They're going to have to go out and buy a whole new airplane. And, Junior, who's just getting out of high school, is learning to fly. He can be the pilot on the second airplane. And now they've doubled the size of their assets. But their sales don't quite increase on day one. They have to build back up to that. So this becomes a standard business problem. That how do we add assets when the assets can only be added one factory at a time, one airplane at a time? And so the line is not a smooth line coming out of the origin or at some point on the axis, but rather it's a little bit kinky. The third case is that we started off with a basic assumption that we were operating at 100% of capacity. Now, what if with our existing base of fixed assets, we could have actually produced more than 3 million. We could have produced 3,125,000 in total sales because we were only operating at 96% capacity. The target fixed asset, 2 million divided by 3.125 million, says that the line or the slope of that line is not 33.3, but it's 32%. And so if we change our fixed assets to sales ratio to our target fixed assets to sales, 32%. That means we'd have 32% times 3.3 million, and that essentially says that the new required fixed assets is 1.056 million. Before it was 1.1 million, so we're actually $44 million better off. We don't have to spend quite as much money to grow the business. How would that affect AFN? As we've previously predicted, we need $100 million in new fixed assets. With the excess capacity, that means the actual required would only be 56 million, saving of 44 million. And so our predicted AFN would be the 114.7 minus 44 million, means we only need $70.7 million. So, in summary, looking at those three special cases about asset to sales, excess capacity lowers our funding requirement. Economies of scale lead to less than proportional asset increases, and lumpy assets means that from time to time we have to make a huge investment in additional capacity, but we may go from one period to the next without actually having to do that. That's a lot to look at, a lot to think about in those two methods that we've looked at over the last 40 minutes or so. In summary, I'd like to remind you that the value doesn't come from balance sheets and income statement. It comes from the decisions that we make and the actions that we take in regard to the company's future. What assumptions we make essentially come from the decisions that we predict we're going to make. We're going to increase our inventories. We're going to increase our fixed assets. Forecasting revenue and ultimately the profit and the cash flows of the business is definitely something that we deal with scientifically, but it starts off with assumptions. And those assumptions come from intuition, from judgment, and that makes it much more of an art than a science. Like forecasting the weather, it's an art as well as a science, especially as we're predicting a long time into the future. The AFN method that we looked at first provides a very simple and intuitive way of understanding the funding requirements of a business. The percentage of sales is much more work, but it provides us with much richer information and allows us to test the assumptions that we've made. Thanks for paying attention for about the last 42 minutes. I know it's a bit of a long video. In the next session, we're going to start to take a look more at how we apply what you learned in working capital to understanding value creation in the firm, and we'll turn these predictions into an estimation of share value. I look forward to talking to you about it then. Cheers.